Have you ever felt that squeeze on your wallet getting tighter and tighter? It's not just you. It's all around the world, from big governments to small families. Debt is piling up at an alarming rate. And some experts are pointing their fingers at the year 2026, whispering about a potential global debt crisis. Is this just fear-mongering, or is there a real storm brewing on the horizon? Today, we're going to break down what's really going on, why 2026 is a year to watch, and most importantly, what it could mean for you and your money. So, let's start with the big picture. What is a debt crisis? Imagine a domino effect. One country, company, or even a large group of people can't pay back their loans. Lenders get nervous and stop lending. As credit freeze spreads, causing businesses to fail, people to lose jobs, and economies to shrink. We saw a version of this in 2008 with the housing market collapse. But the situation today is different, and in some ways, much bigger. After the 2008 crisis, central banks around the world, like the U.S. Federal Reserve, slashed interest rates to near zero. This made borrowing money incredibly cheap. The goal was to encourage spending and investment to get the economy moving again, and it worked for a while. Governments borrowed to fund infrastructure and social programs. Corporations borrowed to expand and buy back their own stock. We, the consumers, borrowed for homes, cars, and education. It was a decade-long party of cheap money. Then, the pandemic hit. To prevent a total economic meltdown, governments unleashed a tidal wave of stimulus money. They sent out checks, boosted unemployment benefits, and offered loans to struggling businesses. This was a necessary lifeline, but it also poured gasoline on an already smoldering fire of debt. Global debt levels, which were already at record highs, shot into the stratosphere. We're talking about a figure so large it's hard to wrap your head around. Over $300 trillion. Now here's where things get tricky. That era of super low interest rates is over. To fight the inflation that surged after the pandemic, central banks had to raise interest rates, and they did it fast. Suddenly, all that debt that was so easy to manage became much, much more expensive. Imagine your adjustable rate mortgage payment suddenly doubling or tripling. That's essentially what's happening on a global scale. This brings us to the year 2026. Why is this year so significant? It's all about timing. A huge chunk of the corporate and government debt that was issued during the cheap money era is set to mature, or come due right around 2025 and 2026. Think of it as a massive bill coming due all at once. When this debt matures, borrowers have two choices: pay it back in full, which is often impossible, or refinance it, meaning they take out a new loan to pay off the old one. But here's the problem. Refinancing in today's high interest rate environment is a whole different ballgame. A company that borrowed $1 billion at 2% interest might now have to refinance at 6% or 7%. That's a massive increase in their annual interest payments, squeezing their profits and leaving less money for hiring, innovation, or even just keeping the lights on. This is what experts call the refinancing wall. It's a giant hurdle that trillions of dollars of debt have to clear in the next couple of years. So who's most at risk? Let's break it down. First, we have governments, particularly in emerging markets. Many developing nations borrowed heavily in US dollars. Now, as the dollar has strengthened and their own currencies have weakened, their debt burden has become heavier. They have to pay back their dollar-denominated loans with a currency that's worth less, a painful double whammy. We're already seeing countries like Sri Lanka and Ghana default, and many more are teetering on the brink. Even major economies aren't immune. The United States, for example, has a national debt exceeding $34 trillion. The interest payments alone on this debt are projected to become one of the largest items in the federal budget, surpassing spending on defense or Medicare. This puts immense pressure on government finances and could lead to tough choices down the road, like cutting services or raising taxes. Then there's the corporate sector. During the Larat years, many companies with weak financials, sometimes called zombie companies, were able to stay afloat simply because borrowing was so cheap. They weren't really profitable. They were just borrowing to pay off earlier debts. Now that the cost of borrowing has surged, these zombies are in serious trouble. A wave of corporate bankruptcies could lead to significant job losses and ripple through the entire economy. It's not just the weak companies either. Even healthy corporations will feel the pinch of higher borrowing costs, which could slow down economic growth. And finally, what about us, the individuals? We're feeling it too. Credit card debt is at an all-time high. Auto loan delinquencies are rising. Mortgages are more expensive than they've been in decades. Many families are stretched thin, using debt to cover the rising cost of living. If a wave of job losses were to occur due to corporate failures, many households would find themselves unable to manage their debt payments, creating a vicious cycle of foreclosures and financial hardship. So, is a 2026 crisis inevitable? Not necessarily. There are a few things that could change the trajectory. Central banks could decide to start cutting interest rates again if inflation cools down significantly. This would provide some relief to borrowers. Governments could also implement policies to manage their debt more effectively, though this often involves politically difficult decisions. And on the corporate side, many companies have been working to shore up their balance sheets in anticipation of this challenge. But the risks are very real, as the world is walking a tightrope. On one side, if interest rates stay high to fight inflation, it could trigger this debt crisis. On the other side, if central banks cut rates too early, inflation could come roaring back. It's an incredibly delicate balancing act with no easy answers. What can you do to prepare? This isn't about panicking. It's about being prudent. The first step is to get your own financial house in order. Focus on paying down high-interest debt, like credit cards. Try to build up an emergency fund that can cover 3 to 6 months of living expenses. This cushion is your best defense against an unexpected job loss or financial shock. Review your budget. See where you can cut back on non-essential spending. In a high-inflation, high-interest environment, every dollar counts. If you have investments, it might be a good time to review your portfolio with a financial advisor. Make sure your investments are diversified and align with your risk tolerance. Don't make rash decisions based on fear, but be aware of the changing economic landscape. It's also a good time to invest in yourself. Your skills and your ability to earn an income are your most valuable assets. Whether it's learning a new skill, getting a certification, or building a side hustle. Increasing your earning potential provides a powerful buffer against economic uncertainty. Ultimately, the global debt situation is a complex issue with no simple solutions. The decisions made by central bankers and politicians in the coming months will have a profound impact on the world economy for years to come. While we can't control those decisions, we can control our own. By being informed, preparing our personal finances, and staying resilient, we can navigate the potential challenges of 2026 and beyond. It's a story we'll be following closely here. So make sure you resubscribed for more updates and analysis on the economy and what it means for you. Thank you for watching, and we'll see you in the next video.
Household debt tells a similar story. Easy credit, low rates, and rising prices pushed families to borrow more than ever for homes, education, cars, and everyday expenses. When wages stagnate but costs rise, borrowing fills the gap, creating a precarious balance that can unravel quickly if unemployment rises or interest rates go up. And that brings us to a critical turning point: interest rates. For years, central banks kept interest rates at historic lows to stimulate growth, but those days are gone. In response to rising inflation, rates have climbed, and even modest increases dramatically raise the cost of servicing debt. Imagine paying interest on a credit card that suddenly jumps from 5% to 10%. The amount you owe docen change, but what you must pay each month increases significantly. Multiply that by trillions of dollars of global debt, and you begin to see the strain. Here's where history becomes our guide. The early 20th century saw a wave of debt crises that reshaped the world. After World War I, European nations borrowed heavily to rebuild, only to face defaults and economic collapse. The Great Depression was partly fueled by unsustainable debt burdens and the inability of debtors to repay. In the 1980s, a wave of defaults in Latin America triggered a lost decade of stagnation. Each of these episodes teaches a crucial lesson. When debt gets too large relative to the capacity to pay, something has to give. We are now in a similar situation, but on a global scale. Unlike past crises that were limited to specific regions or countries, today's debt is interconnected through a web of financial markets, trade relationships, and global capital flows. A default in one country can affect banks and investors worldwide. A drop in one major economy's spending can depress demand in another. The globalization of finance means that shocks travel faster and hit harder. Another piece of this puzzle is confidence. Debt works as long as creditors believe they will be repaid, but confidence can evaporate quickly. Think of a bank run. Even if a bank has enough assets, if depositors fear it won't be able to pay out, they rush to withdraw funds, forcing a collapse. In global finance, confidence is what keeps bond yields low and borrowing sustainable. If the market starts doubting a country's ability to service its debt, yields spike, borrowing costs soar, and suddenly that debt becomes impossible to manage. Now consider geopolitical tensions, trade disruptions, energy price shocks, and demographic changes. These factors add layers of stress to an already fragile system. Aging populations in wealthy nations mean fewer workers supporting more retirees, putting pressure on government budgets and social safety nets. Emerging markets that borrowed in foreign currencies face rising repayment costs as their own currencies weaken. Global supply chains remain vulnerable to disruptions, affecting growth prospects. So what could trigger the crisis? It might be a recession in a major economy. It could be a sudden spike in interest rates. A geopolitical conflict could disrupt energy, supplies, or trade. A banking crisis somewhere in the world could cascade through financial markets. Often, it's not just one factor, it's the combination that overwhelms the system.
But there, something even more important to understand. Governments and central banks have fewer tools than you might think. In the past, they could cut interest rates, print money, or run deficits to stimulate growth. Today, with interest rates already relatively high and debt levels extreme, those tools are limited. Printing money now risks even higher inflation. Cutting rates might not encourage borrowing or investment if confidence is shattered. Running larger deficits to cover interest payments only increases the debt burden. This is why the 2026 global debt crisis may not look like past financial crashes. It won't necessarily be a sudden market collapse or a single dramatic event. Instead, it could be a slow-motion unraveling of confidence, economic growth, and fiscal stability. People might notice inflation spikes, slower wage growth, cuts to public services, or volatility in markets long before the term debt crisis appears in headlines. So what can individuals do? First, understand the risks and don't panic. Education is power. Diversify your financial knowledge and be aware of how debt affects not just governments, but everyday life. Second, consider how global economic trends might influence personal finances, interest rates, loans, savings, investments, job markets. Third, engage in conversations that matter. Awareness and preparedness don't mean fear, they mean empowerment. As we watch these trends unfold, remember that financial history repeats not because we are stuck in a deterministic cycle, but because human behavior, confidence, risk-taking, short-term thinking has patterns. The lessons of past debt crises are clear. Unsustainable borrowing, when ignored, eventually demands a reckoning. The only question now is how and when that reckoning arrives. Thank you for exploring this crucial topic with me here on Hidden Finance Truths. If you found this script insightful and you want to dive deeper into the forces shaping our economic future, please leave a comment below. What part of the debt crisis surprised you most? And if you think others should understand these truths too, share this video with friends, family, and anyone who cares about the financial future of our world. Remember, knowledge shared is power multiplied.